Good evening, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully you guys had a very beautiful weekend, that you had a very nice Monday session in the markets as well. In terms of today's price action, the S&P up 1% and the Qs up 1% as well. And overall, it was a fairly nice relief bounce rally day in most of your major sectors. Now, the VIX did come down today a little bit. As you can see right here, the VIX down about 13.4% off of last week's highs. We also had the barrel of oil come down a little bit as well, off from the $100 highs that we were very quickly approaching over the course of the Friday session and even into the pre-market hours very early this morning. So that being said, after one day's worth of a bounce, is the massive market destruction over? Is the narrative over to begin with? Or is it just a dead cat bounce? And can we possibly be expecting more downside? Well, of course, we're going to talk about all of that in today's video. We're going to recap, number one, a few of the current wartime headlines in terms of what's happening with the Strait of Hormuz and a couple other headlines out of the administration. After that, we will take a look at some statistics in terms of the market. You guys know over the past week and a half during this conflict, as we've evolved in terms of price action and positioning, well, I always love showing you guys statistics, right? In terms of where the VIX stands, where the put to call ratio stands, where institutional positioning is right now, where is retail sentiment as well. So we'll do a little bit of statistical analysis in terms of whether or not it's a decent time to still be buying these dips or should we stay away. And then we got to recap some other tech headlines because, of course, NVIDIA had their GTC conference, which will be lasting a good portion of the week, but Jensen Huang coming out today and dropping a banger of a keynote speech. So we'll recap a few elements there as well. So we'll spend about the first 10, 15 minutes talking about all the various news elements, statistical elements, and then some recaps from NVIDIA's GTC. After that, we'll get into some charts and talk about the S&P, the Qs, after today's bounce and fairly broad market participation. Where do we stand across many of our favorite sectors, and are we able to find some nice opportunities within those sectors as well? So we'll check on the rotation amongst the indexes. After we're done that, we'll take a look at our big tech names because big tech names today had a pretty good bounce. We haven't really changed any major trends to the upside. However, we're noticing some little sentiment shifts across big tech and also some slight price action shifts. So once again, we will derive which of these companies are great in terms of swing trade opportunities and or long-term investment opportunities as well. And at the very end of the video, of course, we'll get into everybody's favorite segment of the market, which is the biggest gainers and losers of the day. So we'll be talking about some names that are unfortunately red yet again, but we'll also be talking about some names that had very strong pushes off of some of their recent lows and some nice trend continuations and how we can possibly benefit from positioning in some of these names. So we'll recap all that for you today. Once again, let's jump right into the action, shall we? So the S&P up 1%, the Qs up 1% as well. And overall, guys, very nice breadth recovery day. Take a look at the heat map right here. All of your sectors participating to the upside, which is a stark contrast to many days that we've had in the past 2 weeks. It's been a while, right? Over about a week and a half at this point that we've had a day where you've actually had everything coming up to the upside. All of your tech sectors, not even software being left behind this time. All of the banking sector as well, participating well. Most of all the healthcare sector too. And the bottom half of the market, very nice participation in a broad market fashion. And today was not as volatile as of day as we've been used to in the past week and a half with all the headlines coming in all throughout the day. The price action didn't really change. We opened green and we stayed pretty strong green all throughout the day. Moving into the one-day relative, you can see that even better. Most of all, actually all sectors participating to the upside. Only consumer staples still a little bit weak, but we were led to the upside by technology, cyclicals, and financials. Three sectors that have been struggling as of late. On your 1 week relative, still the damage has been done, and your only two positive sectors remain to be energy and utilities. Everything else to the downside, but technology quickly coming into fourth position here. Not too bad. As I said today, decent little relief rally recovery bounce. We will see if the market's able to line up 2 green days in a row because it's struggled to do that so far. We'll see if this actually lasts or if the downtrend proves to be too strong. And if we have to maybe revisit the infamous 200-day EMA, which is slightly below the price right now on the S&P and also slightly below the price right now on the QQQs. But overall today, we'll take it. Very decent day for taking profit on any short puts, especially the ones initiated late last week, or selling some covered calls, benefiting from the remaining volatility. But we'll talk about that all throughout today's video as well. Fear and greed index right now still in extreme fear categories because we know market momentum has been very weak. The S&P pulling back into some of its major moving averages. You'll see here that it's below its 125-day, which is what CNN uses to establish a fear and greed read. The stock price strength in terms of net new 52-week highs and lows on the New York Stock Exchange, collapsing, of course, over the course of the past 2 weeks because of the conflict right now. Stock price breadth also in extreme fear reads. We've been doing a good job of covering that on our own in terms of percentage of stocks above their 20-day EMA. We had a nice little bounce today, but still at relatively low levels. 27% of all stocks above their 20, very low. In terms of historical context, is it indeed a nice buying opportunity area? Yes, it is. Percentage of stocks above their 50-day EMA also at a 31% read. Is it a very good chance to be buying some of these dips? Yes, because although we can go a little bit lower, guys, this is the entire range. We're not trying to pick the absolute bottom. We're trying to pick within a range of the bottom to get the best possible deals. And percentage of stocks above their 200-day EMA coming up slightly over the course of the day today, but not much improvement. Still only 47% of stocks above their 200-day EMA. And we've fallen off pretty fast here into oversold conditions as well. So that is probably why the market got a broad market relief bounce, because broadly speaking, all of your breadth indicators, whether short-term, medium-term, or longer-term, really hit oversold conditions rapidly over the course of the past 2 weeks as we kept losing one sector after the other. So as a result, you are still in extreme fear territory. Momentum is still very soft. Market breadth is still very soft. But we know, especially when we went over the statistics of the market over the course of the past week, there has been tremendous buying opportunities or capacity to buy dips slowly and carefully, but definitely something that we do want to be taking advantage of, right? In terms of what we have to look out for the remainder of the week, obviously the biggest day is going to be Wednesday, where we get the press conference with Jerome Powell. There's not going to be any interest rate cuts. The market is not pricing anything in for the Wednesday session, but the emphasis will be on the press conference and Q&A with reporters that are going to be asking Jerome Powell about the status of the economy in relation to our most recent quite soft GDP print, although it was obviously affected by the government shutdown last quarter. They're going to be asking him about the state of inflation, whether or not the Fed deems it to be a something that could be structurally increasing over time and persist, or maybe just a one-time event just due to the price of oil and impacts on the prices of energy and transportation on final goods. And obviously, they're going to ask him about the good old labor market. We know we got the non-farm payrolls not too long ago, minus 92,000 jobs to be specific. So all those questions, we will see how Jerome Powell and the Fed has chosen to respond to those questions. So the volatility is not going to come from the actual rate decision. No, it's going to come from the post-rate or the post-written statement discussion and to how he answers questions. So please keep that in mind. It's your most volatile day of the week in terms of any macroeconomic releases, because other than that, there's really not that much to be looking forward to, right? So keep that in mind. That's a bit of a snapshot of what happened over the course of the day today. Improvements in breadth, improvements all across the board in terms of a broad market rally recovery, but still in the overall context of a daily downtrend. So the bears are indeed still in control. We will see if the bulls have it in them to change that over the course of this week. Now, before we get into more technical analysis, let's do a quick little recap here of the news cycle that happened over the course of the weekend. And we're going to start it off, of course, with a recap of the wartime headlines. So number one, obviously, this war has left a lot of people feeling very bearish. This is the AAII Investor Sentiment Survey. Where do the members feel the stock market will be in the next 6 months? As you can see, almost 47% of all people are very bearish on the stock market in the next 6 months. The last time it hit some of these highs was really close to the Liberation Day bottom, when everybody is starting to feel bearish, when it's getting very crowded on that side of the trade. That's how you know that the narrative is really built, the sentiment is really built, and with good reason, obviously. There are many problems right now, especially with the Middle East situation, right? But the question we always need to be asking ourselves is it as bad as it was at the start of the conflict, or has it been getting progressively better over the course of the past few days, past few weeks as well, right? We are now further along, in my opinion, to some sort of resolution, whether that be through military implementation of naval escorts in the Strait of Hormuz, or possibly a ceasefire overall. We weren't that close to that 2 weeks ago when the whole conflict started, yet people are getting more and more bearish, right? So this is kind of lagging what's actually happening, but that's usually the case, right? We want to be contrarian to the herd overall. Moving on a little bit further here, some insights in terms of the ships passing through the Strait of Hormuz right now. You can see before the conflict, They had their average, and now since the conflict, still nothing. And that is similar to today and yesterday over the course of the weekend, only a couple ships making it through. So this still remains the largest problem. Now, what has the administration been doing to kind of counter this problem? Well, obviously, over the past few days, we've talked about this one right here, the pipelines either from Saudi Arabia through over to the Red Sea or the one from the United Arab Emirates into the Gulf of Oman. They are now clipping into maximum capacity, about 7 million barrels per day from the Saudi Arabian pipeline and about 1.5 to 1.8 million barrels per day from the UAE. The total amount of oil that's being, held back from passing through the strait is about 20 million barrels per day. So these pipelines are contributing to at least 1/3 of what we're missing right now, but not everything, obviously, right? A little bit further here. So just to recap, because we're not going to go through all the headlines, right? Nothing really happened over the course of the weekend, guys, to be quite honest with you, other, of course, than the big CARG headline whereby the United States struck several military installations, naval installations on CARG Island, which is where Iran has most of its oil storage depots and some of its oil refineries, also known as their crown jewel. President Trump not choosing to strike any of the oil depots for the current moment, right? So where do we stand with all of this, okay? Well, the two things that we keep looking for here on the channel, it's been very clear. We've had the same stance here for the past week and a half, right? If there's still no straits, no ships going through the strait and still no ceasefire, well, you don't have any form of resolution whatsoever. So although you can have nice bounce days like this, the market's not going to truly get some phenomenal lift and some trend continuation to the upside until you solve one of these two issues. The conflict can keep going on without a ceasefire so long as you start getting ships through the strait, because we know right now the price action of the markets has been completely inversely correlated to the price of oil. If oil has large up days, the S&P and the Qs are going to go down. If oil has a nice down day like today, conversely, equities have a very good chance of going up. So this is very simple, right? Very simple to understand. But what have we got as in terms of improvements over the last week or so? The SPR releases 550 plus million barrels amongst the G7 members, which gives you about 3-4 weeks of runway. You got the Saudi and UAE pipeline set to maximum capacity, which we just talked about. You have calls now for G7 members to help secure the strait with their own naval vessels. France so far has answered the call, but remains to be seen if the UK and other partners such as Japan or Korea would be willing to do that in terms of Navy escorts. Additionally, at the same time, you got $20 billion of insurance via Chubb. Right? So that's something we didn't have about a week and a half ago when this conflict fully started. It doesn't mean that ships are going through. It just means insurance is available to them. And should you have some escorts, well, they're probably also going to take the insurance as well and make their way through. You do have military superiority, mainland and on CARG Island right now, which is good. Nobody's ever doubted that, right? The number of missiles and drones from Iran are down 95% from the first day of conflict. So that is a clear improvement too. And the last one, which we just got over the course of the weekend as well, which is Iran letting non-US allied vessels through, which is a combination of Chinese vessels, Indian vessels, right? And then those two countries can obviously sell that oil to the rest of Southeast Asia or Asia that are currently tapped right now on in terms of just supply coming out of the strait, right? So we do have some clear improvements, but still no big ones. So there's no sense in me recapping every single tweet, every single press conference from President Trump, right? We know things are progressively improving. We're finding temporary band-aid solutions, such as the SPR, such as the pipeline, such as the insurance, and potentially some more military presence in the region by other G7 members, but still no ships going through the strait and still no ceasefire. So as a result, we can't really hang our hats up and say, yeah, all right, perfect. The volatility is maxed out right now. The price of the barrel of oil is maxed out and it's happy days ahead of us, right? We got to take things one day at a time in terms of managing our positions overall and take advantage of these green days. Well, take advantage of the red days to kind of farm some premium on the downside, which is what I've been doing, right? You guys know the VIX spikes, you get a big red day. I'm farming premium way below, get a nice green day like this, close the trades, and then kind of just repeat the entire cycle until we solve one of these two very large constraints. So that is pretty much a summary of where we stand in the conflict, right? No sense in me recapping every single little news headline. This is literally where it stands. These are the main bullet points. Moving on a little bit further here, guys. So Goldman Sachs reiterating something that we've been saying as well. And this has to do with the bearish narratives that are in the market right now that we keep recapping every single day. All of these, they're nothing new if you guys are frequent viewers of the channels, versus the long-term bearish tailwinds. And Goldman Sachs coming out and reiterating what we've been saying on the channel right now for the past 2 weeks. Here it is. Overall, equities face rising correction risk. Valuations are stretched, macro conditions are deteriorating at the margin, and cracks are appearing across growth, inflation, credit, and labor markets. Nothing new. But strong fundamentals argue against a bear market, reinforcing the view that weakness should be temporary as the medium-term backdrop is more constructive. Earnings remain resilient, balance sheets are solid, and history suggests that geopolitical shocks often present opportunities rather than lasting damage. So either Goldman Sachs is watching my videos or this is just an institutional take, right? Meaning that we know we have short-term issues right here, and we've covered them almost every single day over the past month or so, right? That being said, the bullish tailwinds are also very real. We do have strong GDP forecasts for this year. You are in a rate-cutting environment, despite the fact that potential rises in inflation are maybe going to taper back the amount of rate cuts, at least that the market expects. Now, we're also pretty sure, if you read between the lines, right? Pretty sure the Fed's going to cut rates, but they're not going to come out and say that just yet. Still at low unemployment, still at low-ish inflation, but once again, you could see a temporary, we're down like this, you might see a temporary upswing, but overall, I think the deflation trend is fairly set in motion right now. You have very strong earnings, the AI megatrend, and the massive amounts of fiscal stimulus and deregulation as well. So this is the institutional take right now that Goldman Sachs has published. And as I showed on the chart yesterday, right? These are your charts for the average in terms of market performance when a geopolitical conflict starts to where it culminates. And that's why we look for the culmination of different things, the culmination of sentiment, the culmination of narrative, and the culmination of positioning with volatility, which are going to be the next slides, right? And then you tend to have a very nice rally recovery thereafter, right? So you're looking for things to improve before the market prices in those improvements, which is a kind of situation we're in right now, right? And then eventually when you get the end of the geopolitical event, well, then the markets really rally in a drastic fashion to the upside. So that's why we want to be positioning here, because we don't want to miss that big rally recovery, right? So keep that in mind. We're positioning slowly and carefully, not going all in saying, this is the bottom. No, this is the bottom. No, this is the bottom. No, we want to be buying progressively at key levels in terms of oversold conditions or oversold breadth conditions, and kind of layer on, stagger in to the position. That way we know on the other side of things, we're going to find heavy rewards. And also this one here, what happens to stocks after a surge in oil? This is the 1-year forward return following a 2-day oil surge of 20% plus. You can see that all of them, except for the great financial crisis, I mean, with good reason, it wasn't started by oil, right? It's just that oil was high into it. Moving in, all of them show very positive returns on a 1-year forward basis. So if we're a long-term investor, should we be doing this? This chart isn't for trading, right? Because you'll say, well, Will, what does this do for me if I'm just looking to, trade for the next 1-2 weeks? Well, the answer is absolutely nothing, right? If you're trading for the next 2 weeks, you guys know exactly what to do. I've said it many times, right? Take advantage of the volatility, sell put options on VIX expansion days, big red days on some of your favorite stocks. And then when you have nice little pump days like today, you can take it off the table, take the buying power back, and that's it. But if we're running either leap call options or long-term position shares, right? I think these statistics here are fairly clear, at least in terms of historical standards, right? Moving on a little bit further here, we talk about the put to call skew. How many people are buying out of the money puts versus how many people are buying out of the money calls? Very easy, right? A 25 delta put versus a 25 delta call. This shows it's just too many people, right? 74% of S&P 500 stock with a 1-month skew. It's almost over 80%, right, of people, they're heavily tilted right now to the downside, buying a lot of out-of-the-money protection. And I mean, just look at all the prior events. It should be very obvious what happens, right? It doesn't mean we can't go up further. Of course it does. It just means that when you approach these levels, well, we can't necessarily be pivoting right now, right? No, because now it's the crowded trade at the current time, and you are paying a very big volatility premium for those. You'll notice that Liberation Day or the inflation shock right here in late 2022, early 2023, COVID, tariff escalations before that, Fed hikes during a trade war, which is 2018, 2019, and then the China yuan devaluation back here in 2015, 2016, all other very large events. And one thing is very clear on this chart, right? When you start approaching the top end, are you closer to the end or not? That's the question you should be asking. Not is this absolute bottom, is are we closer to the beginning or are we closer to the end? Meaning, should we sell everything right now and fully load up to the put side, or is it possibly too late? Well, you're coming into the area where it's too late. It's fine to be hedging, but selling everything or whatnot when the market is pricing in this amount, right, without the markets having dropped that much, It's a bit tricky, isn't it, right? You cannot say the risk reward is in your favor at the current time if you're willing to fully position bearish. Moving on a little bit further here, this is your expected value in terms of shorts right now. So you can see these shorts are printing the highest that they have since the Liberation Day events. That one as well, right? So US listed ETFs. I showed you guys some statistics last week that showed that institutions are very long, leveraged long on individual names. However, the long-short trade is that they are long individual names, but they are short the ETFs and the indexes as a hedge. So keep that in mind. Usually when you see peak short positioning on ETFs like that, once again, trade is getting very crowded, and we know that the indexes haven't necessarily broken down in a rapid fashion, at least not yet, but it just goes to show you the positioning is very lopsided right now. We also threw in the New York Stock Exchange McClellan Oscillator, which is a good gauge of market breadth. And you'll see here, this timetable runs from the period of time in 2024. This first circle right here is the inflation scare in April of 2024. Late 2024, July and August, that is the yen carry trade unwind. April of 2025, obviously Liberation Day tariffs, and here we are right now at extremely low market breadth reads, extremely low RSI on the McClellan Oscillator Index, so everything is super oversold. At that point in time, you would like to believe that we should be taking a bit of a contrarian basis, not going all in at one price, but right, we should starting to be positioning into some of this weakness overall, at least in a lot of individual names that are already down 20, 30, 40, 50% from their local highs, despite indexes holding up very well. More breadth indicators, this time on the SPY, not the New York Stock Exchange, but directly SPX, already oversold. When are the times that previously happened? Well, synonymously, right, you'll see a lot of market bottoms right here. Whether it's the October bottoms, right, into November of last year, whether it's some of the ones that we saw in late July into the early portion of the fall, or actually during Liberation Day. Usually when you get that oversold in terms of market breadth overall, okay, well, it's a good indication, right, that we should also be participating. Moving on a little bit further, smart money, dumb money, confidence. At this point in time, same thing. This is positioning, retail versus institutions. I spent a lot of time on this on Thursday. Dumb money, what is dumb money doing? Well, you can't necessarily see it from this chart because they hit it, but retail, it's not called, we don't necessarily have to make the delineation, right? It's just institutional and retail volumes right here and their confidence and their positioning. That being said, at the tops of the market, retail was, for all intents and purposes, overbought conditions. What have they been doing? You can't see it, but you can see the end of the line, right? The velocity of retail exiting the market over the course of the past 2 weeks with this conflict is quite substantial. The institutions have picked up their buying volume a lot since that time. So you now see the good old flippening happen. And usually you only see that flippening happening, right, when the institutions are ready to call out, you know, any short-term volatility. They're willing to buy short-term volatility and short-term declines in prices because you would like to assume that they are, well, not you would like to assume, you do assume that they're going for the medium to longer-term bullish tailwinds. We know that retail, is very prone to reacting on headlines, whereas institutions kind of a longer view in terms of positioning because they have to deploy a whole lot more capital. That's your advantage as a retail investor. You can be very nimble with your capital. Institutions, they take a very long time to build positions or to get out of positions just because the positions are so large. So pay attention to this positioning flip here. Very important for the markets right now. That's everything for statistics, right? So what have we covered in summary, right? Institutional versus retail positioning, it shows not only by this chart right here, but by your Goldman Sachs memo coming into this right here, right, that they do argue that short-term volatility and short-term correction possibilities are a very real thing. However, medium to long-term, they are still very bullish. And you can see that in terms of their positioning, what they're doing right now. We also talk about the fact that in terms of, put to call skew or historical performance or whatnot, right? Put to call skew, the amount of short positioning in the market right now, the breadth being oversold on the New York Stock Exchange and the SPX, everything points to the fact that should we be nervous right now or excited? Well, you should be excited and you should have a plan to be buying at certain key levels, especially on some of your favorite high quality companies. As I said, the indexes haven't dropped too much, but a lot of very solid companies have, and they're already at very good valuations. So we should be willing to pick those up as slowly as you feel comfortable with doing, right? But we should be participating and not just saying, well, there's too much volatility, too much uncertainty. The situation in Iran is getting worse, right? As a matter of fact, it's not getting worse. It's getting progressively better, right? Could there be lasting effects on the barrel of oil? Of course there can, but that's not what the markets do, right? The markets price in maximum pain, maximum damage initially, and then work backwards from there, right? So it doesn't mean that even though oil, and you can see that many times in the past, we went over it last week, it doesn't mean that just because oil can go up here and then come down and stay somewhat sticky around 90 to 80, that the S&P is going to do the same thing, have a massive crash and then stay super low for a long time. No, the market's very fast to price in these effects and will reverse super quick as well, meaning that you could very well, if the conflict ends, oil can very well stay down here in 80, 85, and the S&P can crack all-time highs. If you're looking for the S&P and the Qs to hit all-time highs, and for that, you're looking for oil to go all the way back to 60 or 50, it doesn't work like that, right? It can actually move, the equities will move a lot faster than oil will come down and correct back in price, right? It all has to do with volatility and expectations, guys. The market is a expectations-driven thing, right? It prices in forward expectations, not what's happening right now. No, it prices in the worst case scenario for the short and medium term. And then if it's not as bad, it starts unpricing those events very, very quickly. So keep that in mind. That's the conclusion of all these statistics. Hopefully you guys enjoyed. A few more statistics here from the NVIDIA conference. NVIDIA CEO Jensen Huang saying NVIDIA now sees, this is crazy, at least $1 trillion in high confidence AI infrastructure demand through 2027. That's their new guidance. That is absolutely insane. Up from $500 billion last year, with 60% of demand coming from hyperscalers and CUDA, in cloud AI narratives. This is a big chart. When he said that, okay, it was absolutely nuts. NVIDIA stock price actually jumped on that, but then the algorithms did what they do and they kind of sold it back down because there's a lot of macro hedging going on in the markets right now, right? Not able to run, but that was absolutely insane. We are just not, well, not me, I'm very bullish, right? But a lot of people are just not bullish enough on this entire AI revolution, right? So NVIDIA putting up twice the guidance that they'd previously listed, and that's insane, right? We'll talk about it more when we do NVIDIA's valuation, but if you're talking about $1 trillion in revenue through 2027 at 50-60% margins, which is what NVIDIA is doing right now, net margins, I mean, you're talking about a company that would be trading at end of 2027 earnings at about an 8 to 10 forward multiple. They're trading at about a 20 right now, but if you increase the guidance by that much and you retain margins, the stock is trading extremely, extremely cheap right now, right? And eventually the market's going to realize that, but you know how it is, right? The market doesn't really understand the agentic AI pivot with tokens that NVIDIA is doing right now, and a lot of software companies are doing right now as well. We talked about this when we covered hyperscaler earnings and how Wall Street is wrong to deem that the free cash flow utilized to build all these data centers is not going to lead to positive operating margins. It's just not true, right? But we've talked about that many times over the past month and a half. I'm not going to do a recap here. Maybe I can redo it like maybe tomorrow or something like that. But suffice to say, Wall Street is just not, they're not giving them the benefit of the doubt, and they also don't understand exactly the pivot that's been happening now since October to agentic AI. No longer generative AI. It seems as though Wall Street is still stuck in the generative AI, which was last year prior to the fall, and are not yet in the inference/agentic AI models that these companies have been talking about and building for this year and next year and onwards, right? All about this token generation and AI factories that they're building, not just to generate AI slop, right? No, it's agentic AI that matters a lot. And Jensen talked about this today in terms of how those various companies will utilize tokens in the future in terms of employees and things like that, right? So highly recommend you guys watch the GTC conference if you haven't, because there is still some big alpha guys in big tech and also NVIDIA. People just don't, the street just doesn't see it coming, right? I know a lot of you guys do. A lot of people, retail doesn't understand this, and a lot of Wall Street doesn't understand this as well. They haven't priced it in just yet. Moving on a little bit further here, NVIDIA also announces a new partnership with BYD, Hyundai, Nissan, and Geely for its robotaxi-ready platform, alongside a new partnership with Uber to deploy and connect robotaxi-ready vehicles across multiple cities. This is nothing new. NVIDIA actually partnered with Uber last year with Mercedes and Toyota, but now is increasing their partnerships. And every time NVIDIA partners to build robotaxis with new car manufacturers, as a matter of fact, this guy left out GM, but he name dropped GM as well. Every time NVIDIA partners with one of these companies, they are all being funneled to Uber's network. And Uber's stock price actually had a very nice jump here in the after hours when Jensen was talking about that. So people that believe that Uber will be disrupted by the AV narrative, it's just not true, right? The price action will lead you to believe that, but it has so many partnerships, whether it's with Waymo or whether it's with all the customers that NVIDIA is funneling to them. The stock right now is trading very cheap in relation to its forward prospects. So keep that in mind, right? Moving on a little bit further here, NVIDIA CEO Jensen Huang on comments on CPO versus copper, meaning optics versus copper, because we know recently there's been a lot of talk that fiber optics is the new thing, right? AOI, Light, names like Coherent, names like Fabrinet, et cetera, et cetera, et cetera. And what is being left behind right now are the former glory names such as A-Lab, such as Credo, right? The copper names. And then it's had this big debate online of, is copper on the way out? And now all that people are going to invest in and do are optics because nobody's going to use copper. Well, Jensen Huang came and cleared it up. There's a lot of conversation about, is NVIDIA going to copper scale up or optical scale up? We're going to do both. For the first time, we will scale up both copper and co-packaged optics. Oberon is copper scale up. With Oberon, we could also use optical scale and scale up to expand NVLink 576. We're going to have NVLink 144 with Kyber. And then with Oberon, we're going to have NVLink 72 plus optical to get NVLink. So this would be copper. They're also going to do optical. So both. Is copper going to be still important? The answer is yes. Are you going to scale up optical? Yes. Are you going to scale up? Are you going to scale out optical? Yes. We need a lot more capacity for copper. We need a lot more capacity for optics. There you go, right? So Jensen Huang coming out there and saying both trades are indeed very much still valid. And lastly, Jensen confirming what we are seeing in our GPU availability data. There's an epic scramble for compute. B200 is basically unavailable. Availability for GH200, H100, and A100 is also collapsing. So for those of you saying these guys are building out too much compute capacity, it's just not true. You see these ebbs and flows because every time there is new capacity that comes online, it just gets bid to the floor. It just gets bought up. And as a result, the demand the supply just collapses, right? So the demand for compute is still excessively high, and the prices for compute, right? The prices aren't collapsing that much. You would think that that's the case as you put more and more of it online. No, it always has been a supply problem. There is not enough. So when Jensen tells you there's not enough, these charts that measure the amounts that are being utilized, whenever something comes online, it gets bought up and used immediately, okay? So there's just not enough supply in the markets right now. And last but not least, the big one, Nebius. Nebius signs a new AI infrastructure agreement with Meta up to $27 billion. We are pleased to expand our significant partnership to accelerate the build out and growth of our core AI cloud business. Very strong. Nebius already had a partnership with Meta, but this is a much, much, much bigger partnership, right? They had about $3 billion before, now up to $27 billion. We will talk about Nebius at the very end of the video. I will give you my thoughts because the stock was up 15%. We will talk about it. We'll talk about valuation. We'll talk about whether or not the stock is a buy and all that good stuff, because I have prepared for you guys a little bit of valuation analysis in relation to their enterprise value. But those are the salient facts of today. So what we did is we recapped all of the current bearish narratives, current short-term versus the longer-term bullish tailwinds. We did that a lot last week as well. We also recapped everything that's happening with military endeavors right now in the Middle East. We also talked about all of these statistics, right? All the various forms of statistics that I showed you and derive whether or not it was a good idea to position. So hopefully you guys have enjoyed these so far. I've tried to do a lot of these in the past week and a half because during times of great uncertainty when there's a lot of people that are just doom and gloom right now, right? But there's also a lot of people that are saying, oh, everything's overblown, it's a nothing burger. When in all reality, guys, the answer is in between. You have to be cautious, but you also have to be optimistic. Your positioning as a trader is going to be different than your positioning for a long-term portfolio. Of course, if you're trading the markets right now and you know there's not many themes that are trending, well, if you are a trend and momentum trader, you would play the themes that are trending. And we've covered those all through last week. If you're playing volatility, then play volatility. Sell options, it's your best friend right now. Those are the only two things that you can do if you're trading the markets right now, right? Very quick ins and outs if you're volatility scalping, or if you're momentum trading and trend trading, well, you got to stick with the names that have been trending so far. And we talked about them last week, some energy names, defense names, et cetera, right? And obviously, you know, some of the ones that have come recently, such as the agricultural plays, the fertilizer plays, et cetera, right? You guys all know about that. If you have a long-term portfolio, should you just be staying out of the market right now and not willing to buy whatsoever? No, because we've literally spent 10 minutes in almost every video of the past week, talking about the statistics right now tell you, as a matter of fact, you should be buying in these times of high uncertainty, high volatility, right? A lot of narratives, competing narratives at the same time. Favorite companies down 20, 30, 40% from their highs. We should be buying. History tells us, actually, as a matter of fact, it is a very good time to be buying, not sitting on our hands, scared of the markets right now overall. So hopefully all that makes sense. I spent a lot of time on it today. Expect me to spend less and less time on this. The first 2 weeks of this conflict so far, we spent a whole bunch of time talking about reading the positioning, reading the volatility, right? Smart money versus dumb money stuff. I'll keep bringing them up, but I'll start doing less and less so we can focus on the charts, because I'm now taking for granted that you guys kind of understand how to approach this type of market environment. So that being said, that's the first part of the video. Very long, as per usual, but I think the context matters so much more than me just going through the charts here, guys. The context, the positioning, the volatility, right? It matters so much more than me just saying support's here, resistance is there, and uptrend, downtrend, stuff like that. It's you have to look at things with a holistic picture. You have to understand those statistics. Then that gives you, right, when you then go through the technical analysis, you combine both of them, and then you add number 3, which is fundamental valuation of a lot of our individual names. And that's how you get what I like to call confluence of factors. The more factors of confluence you can line up, the more of a better educated decision you can take in your trades and your long-term investments. So now let's get into our charts. Okay, in terms of the technicals on the indexes, we're going to go through these relatively quickly because not much has changed. The bears still in control of this daily downturn right now. Line in the sand, obviously, guys, is the lows, 661, 66. You want to see the bulls line up at least 1 or 2 more bullish days like this and try to get some form of an engulfing move going. If that's the case, we can rekindle our support level right here, and we have a nice base to kind of load up from, right? However, we know that this all hinges on one of these 2 things. No ships in the strait and no ceasefire. As long as that does not change, well, it doesn't necessarily mean that you're going to come tumbling down right now. It just means it's going to be excessively choppy, and it's going to be difficult for the bulls to mount a successive batch of rally recoveries towards the all-time highs, right? So we could reset to a lower level down here towards the 200 EMA and then just chop around for a while, pending more headlines and more evolution, right? So try to get out of the black and white area of being, well, it's going to rally to all-time highs from here, or it's going to crash down 20% from here, right? It could just be in between, which is what we're seeing right now, a big push and pull. That's because a lot of the positioning, right? Crowded to the downside right now. And you got a lot of hedging going on in the markets too. As of right now, though, daily downtrend. So still a time to be relatively cautious. Next stop, if we do drop a little bit lower, 200 EMA on the S&P, which would be 660 all the way down to about 652. And that would put you down from the all-time highs, roughly about 6%. If you're volatility trading, you're having a very fun time right now. If you're trying to trend trade, right? Well, you got to play the ones that are hot right now. We'll talk about those at the end of the video. Moving on to the Qs right now. Qs, big chop zone. We've been locked here for the past month, right? So once again, avoid speculating in terms of absolutes, saying we are absolutely going to blast off the all-time high from here now, or we are absolutely going to crumble to these lows right now, right? In all reality, it is always gray in the markets. You have to be open to both prospects and follow the data, follow the price action as it evolves, right? So that being said, line in the sand levels still remain at about 592 at these lows. If you break the support, 200-day EMA is slightly closer at the bottom end down here, 582 to about 575. We have not broken this 200-day EMA since the entire Liberation Day event. Now, the bulls still able to control this area, but once again, similar to last week, if you want to see some clear trend reversals, you're going to have to give me a break above 612.59, either through consecutive rally movements, without a ceasefire deal, or without more traffic, just because the market is seeing more of an end in sight to the conflict, or actual conflict resolution in terms of a ceasefire, or find a way to get the ships through the strait. That is the only thing that's going to give you big lift to the upside. Until that time, very volatile time. So if you're trading volatility, quite simple, red days, VIX expansion, selling put options well below the market, as we highlighted yesterday in our top 5 options video, is a very good ordeal. On green days like this, try to avoid chasing the market to the upside. Be very patient, wait for your opportunities, wait for your favorite plays, wait for your levels. Moving on to the XLF financials right now, still weak because we know the private credit narrative, right, has been kind of taking this one down since it rekindled throughout the month of February. So the bears are still in control of this very clean daily downturn right now. Overhead resistance stays put at 50 to about 51.5. If you want to see this reverse, you got to give me the daily uptrend. No daily uptrend. The bears are still in control, and we could indeed test these support lows down here, 48 down to 46. This is where I really enjoy selling put options. You're almost daily oversold. You were until today. You could rekindle them again. Daily oversold conditions on the XLF financials right now. 14, 15% from the highs. Very decent opportunity, whether you're trading Visa, MasterCard, American Express, SPGI, Moody's, or some of the banks on decent pullbacks. Pay attention to them, right? Several of these names, guys, are either oversold conditions or very close. This is Bank of America, right? But several of them, right? Look at all these big sell-off opportunities into historical moving averages, right? They never come down to these levels. So if we're looking for longer-term positions, beautiful opportunities in the market right now across the board in financials, a lot of which don't have any private credit risk whatsoever. Moving on to XLV Healthcare right now. Healthcare also still weak, still in a daily downtrend. So keep that in mind. Overhead resistance is 153, then about 151.5. If we cannot break above and change this trend, quite simply, the bears will remain in control, and we go for the 200-day EMA tap and the beautiful cup and handle on the monthly time frame right here. Yeah, 12 and 26 EMAs, very clean area to be building some positions on healthcare. Breakout, retest, cup and handle, and possibly run, an area that I'm paying very close attention to in the next few days. Moving on to semiconductors right now. Semiconductors, they had a nice little boost today and through the NVIDIA GTC conference, but you know there's still this black cloud overhang in terms of volatility and in terms of the war headlines on a daily basis. So although we have a nice engulfing bounce from the bulls, and they're trying to get a trend change going, if you just fall down, I'm pretty sure nobody's going to be surprised, right? So next area of support, 377 down to 368. On the weekly time frame, we are at the 12-weekly EMA. This has been very good to the bulls, but we got a lot of bearish narratives right now. So you have to be open to the possibility that you lose your market bull a little bit more, and that we finally challenge perhaps the 12-monthly EMA, which will be curling up at the same time. That would give you about the mid-300s, which should be a very healthy pullback on semiconductors. We are still in overbought conditions. This is your lead market bull. So far, it's been holding up well. There are some fantastic opportunities within the SMH, such as NVIDIA itself, such as AMD, such as Marvell on a possible pullback to the 80 zone after their earnings, such as Broadcom down here in the lower 300s. There's a lot of very nice opportunities in semiconductors if you know where to look, if you're looking for longer term positions. Moving on further into our IWM Russell. So small caps right now, still soft, still also in a daily downtrend. Line in the sand is down here, 246. Until you give me a daily uptrend switch, we cannot say the bulls are in short-term control, nor can we say weekly consolidation is finished. Still in a weekly downtrend, still also in monthly consolidation. The next stop, 12 monthly EMA. Beautiful backtest location. That would be down here about 240, 235. So pay attention to that one, right? It's below the 200-day moving average, which we haven't really tested much since that whole Liberation Day breakdown there, right? So decent pullback area for some of the growth names. And we are still in an environment, guys. If Goldman Sachs is bullish on the macro, if you are bullish on the longer term macro, then growth stocks should do very well. I understand that people may not want to touch these in the current environment. You may want to wait for ceasefires or whatnot, right? And that's perfectly fine. It's just to say, if you alleviate some of the short-term pressures, right, growth stocks will go back to exactly what they've been doing for the past 10 months, is responding to the more bullish macro backdrop for 2026 overall. Moving now into XLP, consumer staples, right? So consumer staples falling off a cliff because we know barrel increase, right? Transportation costs increase. These companies don't have the most amount of pricing power. It is possibly going to hit them in the margins, but you see the market is very fast to price in that entire narrative. The larger timeframes at play right here, the monthly, pay attention to it. I'm a big fan of positioning here in XLP if it offers me a bit more of a drawdown. I think the breakout is quite complete at this moment in time. I don't believe we're going to flush and give back this entire yearly move so far. I think we're well underway. The macro does support this as well. It's not my favorite trade, but for those of you looking for value, you are into your retest area, so pay attention to that overall. Consumer retail coming back in a big way. Same concept as some of your staples as well, right? Transportation costs, impacts on margin, et cetera, et cetera, et cetera. You know, we're back testing a very big area, guys. 79 at about 73. So those of you looking for consumer retail plays, because XLY, right? Or, XLY, which is basically consumer discretionary. This one, I don't know why it's giving me these weird charts right here. There you go. This one is mostly Amazon and Tesla. A lot of it, right? XRT is a bit more balanced. So if you're looking for something a bit more balanced, just pay attention to this backtest right here. If you're into consumer discretionary, I'm not playing much consumer discretionary right now. There's too many opportunities in financials and tech for me to play consumer discretionary, but just some food for thought. Pay attention to that backtest. Utilities, very strong. They've kept up. They've kept up this move in a very substantial fashion, right? Although they've been consolidating sideways, we haven't really lost much in terms of price action. Still a very nice weekly uptrend. 46 would be your line in the sand. Come back down here. Nice little back test of the 12 EMA. And the monthly is gone, right? Beautiful monthly expansion trend right now. So any pullbacks, I'll be looking for them, whether we're trading names like Next Era Energy, breakout retest right here, whether we're looking for names like Vistra, off the lows, just looking for monthly higher lows and the eventual ramp, etc. There's many ways you can play utilities. Those are two of the ones that I'm highlighting. There's more, of course, but those are just two that come to mind in terms of power production for the data centers. Real estate, there's just a bunch of REITs. We know real estate's been very soft recently because of the higher interest rates, because of the potential of the Fed not cutting interest rates, because of the renewed inflation fears, etc., etc. Very obvious, right? Whether you want to play XLRE, which is the REITs, you guys know one of my favorite REITs right now, Vici, back down to the same area that we were buying earlier, 28 down to 26. Very nice pocket right there. Obviously, there's more. This is just one that I'm bringing to your guys' attention. Whether you want to play the possible home builders as well, they've been retesting these lows as well. If you have a multi-year thesis, or if you want to play some of the loan issuers, such as Rocket Mortgage, right? Rocket Mortgage unwinding the entire move. We're back to levels that we only saw last summer. I haven't played this one in a very long time. I'm starting to get interested in really playing this one again all the way down here. So there's many ways to play the real estate trade, whether it's the mortgage companies, the home builders, the REITs, all have very distinct opportunities if you know where to look for, whether you want dividends, whether you want the home builders for a theme, whether you want the mortgage companies for the eventual rekindling of the housing market over time. It's a multi-year thesis, not 1 month, not 1 week, not 1 day. No, longer-term position thesis, right? After years and years of it being down, longer-term thesis, and of course, the actual XLE, which is just a bunch of oil companies, right? So this one's been very hot, but not since the conflict. Since the conflict, we haven't really done much. A lot of this move was done leading into the conflict, but not because Trump gave the 10-15-day warning here. They started mobilizing the fleet earlier in January, right? But this one was due to break out anyways. We talked about this one before the fleet even mobilized back in December, saying it was beautiful for a breakout, 4-year breakout of a consolidation range, and it's been moving. So are we late to this trade? Arguably, yes. We are very late. Weekly RSI, very pricey right now. Daily RSI has been oscillating overbought to not. So this one is good, but if you're trading this one, guys, try to just go with the back test of the 12 daily EMA. This is your short-term momentum, right? So this, if we're trading with stop losses, this is where it should be, right? Short-term momentum people will like this one a lot. If you're trying to position for this one for the long term, it's probably not the best risk-to-reward ratio in the entire market right now. You are effectively late to this trade overall. Those are your market rundowns. Hopefully you enjoyed. Moving on to the VIX right now. The VIX coming down in a big way, almost 14% to the downside. Still out of our big resistance range. Resistance range is 34 down to 25. It just means that every time we pull into here, this is why this box is green. When the VIX is high, it's time to buy. Okay, when the VIX is low, well, that's when you kind of got to unwind some of the positions that have probably been heavily into profit, right? But it is definitely time to buy. 25 to 35 is a very good sweet spot. You only really come above this in times of great instant fear and instant uncertainty. Although we have a lot of uncertainty right now, it's been more of a slow move. You had that culmination last week, but so far, more of a slow move than you saw previously, perhaps like last April with the Liberation Day culmination, and prior to that, the big Japanese carry trade unwind that nobody was waiting for, right? So if you're waiting for it, if you're expecting it, you're not going to have some massive surprises like this in the VIX, right? So keep that in mind. Is it still a good opportunity to be selling some options? Absolutely. And buying long stock for long-term portfolios? Absolutely, right? At least that's what history does tell us if we just look at the chart. Moving on a little bit further here, down to gold. So gold and silver, breaking trend right now. Daily downtrend on gold. However, it is just weekly consolidation. Pay special attention if they react and how they react to this 12 EMA because we've held it most of the time over the course of the past, year and 3 months. So it's been a very long time. If you flush this, guys, short-term trades are over. And at that point, you're probably going for larger monthly consolidation, something that we have not done in a while, right? We have not consolidated in big fashion for a while. So short-term trend unwound. First time we've seen a daily downtrend on gold in a very long time, guys, to be quite honest with you. Since back here in October, right? There's been no daily downtrends. There's been daily flushes, but they never rolled over and followed through. This is one of the first ones, right? The bulls still have a chance right here, but definitely, right? 12th EMA is the last of the positioning. So if I'm in gold, which I am right now for a swing trade, my stop loss is below about 48.50, 48.40, right? They flush and close below that. Well, they've done something that they haven't done in a very long time. So you might be expecting more consolidation. That's true on gold, and it should also be true on silver right now. Daily, trying to establish daily downtrend. Support stays put down below here, 75 down to 71, right? Obviously, if you get the breakdown below the 12 EMA, silver is already here. It hasn't done this in a long time. You are currently possibly into a bit of a regime change. You can see that every time we came down here, it recovered. We haven't had a weekly big candle close below the 12 EMA in how long? Similar to gold, right? In like almost a year. So keep that in mind. If that happens, you may be heading into more monthly consolidation, which should just be 12 EMA in the context of a big monthly uptrend. So I'm not saying it's not, this is the top of gold and silver. No, I'm just saying that eventually, as all good things, well, they have to go into monthly consolidation phases and tap their larger EMAs. And if that happens, the position size, I have a swing trade on gold right now, right? If I get stopped up out here and I have to wait for a larger monthly consolidation, the size that I have on right now is small, okay? Going for this breakout and weekly trend continuation. The size that I can put on a trade down here is much larger because it's a much larger time frame trade. So keep that in mind, right? Just something to implement for you guys. Moving on to Bitcoin and Ethereum. Bitcoin and ETH, man, getting some nice action. Not going to lie, over the past 10 days, this is arguably the best 10 days since we've had since the start of the year, right? It's been very nice. Daily uptrend break, finally. A daily uptrend break with substantial follow through. Now we've crossed above the EMAs. First time we've closed above this 50 EMA in a very long time at this point. So now daily uptrend is in motion. Higher lows are established right now at about 66,000, which leads us to believe, okay, if the bulls have this bounce going, right, because there will eventually possibly be a higher low resulting from this, how high can they take this bounce? We're looking for the absolute bottom of Bitcoin. You got to give me one thing. Give me a good weekly bounce. So far, it's a 38.2 bounce. Soft. That's not a very good bounce, right? You need to give me a 50% bounce, which would be 78K, or a 618 bounce, which would be 83. Give me a bounce like that, and we could talk about possibly the absolute lows of Bitcoin being set, because the bulls will set enough movement, enough momentum in motion to reverse that entire trend and start working on the monthly timeframes thereafter, right? But as a result, right now, it's not looking too bad. So once again, longer term positions on Bitcoin, not bad. If you are swing trading, as we said back here, right? If you're going for the swing trades, keep your stop losses below the recent lows, and your take profit targets obviously are into the next band of resistance, which is 85 to 93. And the same thing can be said about Ethereum. It was the exact same concept, right? If we're going for swing trades, we got to keep them below the swing trade lows because you don't want to get invalidated, which was 1900. If you're carrying them higher, take profit range remains 2800 up to about 32. And at that point in time, you're looking for the same thing on Ethereum, right? You're looking for this bounce, which is currently at 38.2. Not bad. It's just okay, right? Nothing to scream home about. Turn it into a 50% bounce or a 618 bounce, then we're interested. Then we're interested in the weekly trend change and the actual true monthly lows to go from more to the upside. Until that time comes, right? So far, as of right now, it's just still a bounce for a weekly lower high, right? It's always going to be a bounce for a lower high. It's just how high do we get? The lower that we bounce, the more inevitable the rollover comes, right? The higher that we bounce, the better the odds of us backtesting and changing the weekly uptrend, something that we haven't done for a very long time. So keep that in mind. Moving on now to our big tech names. All right, moving into Apple, and we're also going to cover these quickly because not much has changed, right? We are still in the context of this daily downtrend right now, bouncing from the 200 EMA, bouncing from support, 256 down to 245. My favorite way of playing Apple, very easy. As I said last night on the top 5 options list, selling puts down here. Red days, decent volatility days, we're trying to max out the options chain and go as low as we can go while still getting 0.5%. As of right now, Apple is just in consolidation phases, right? Weekly downtrend, daily downtrend, as a result, monthly consolidation. Nothing much to see here. Between the 12 and 26, usually a great time to be picking up some Apple. So pay attention to it. If you see it, possibly a nice opportunity to load up on some longer duration plays. The valuation of Apple right now around 250 is still a little bit steep. So long-term shares, probably not the heaviest buy for me, but a little bit of a nibble on Apple down here, especially if the stock moves into that territory, which would be like 13 down to like 19% from the highs. Decent, because the forward guidance for Apple is also quite good, and their product releases have been very strong with increases in your revenue guidance for the rest of the year, which is contrary to what we've been having with Apple in the last few years, which was flat to no revenue growth, right? So distinct change. Moving on to AMD right now. AMD not getting much love today at all, 1.65%. It was green, but largely trendless, right? Still trapped in the chop zone right now. Overhead resistance, 215 to 230, and below support, 188 to 179. Let's just call it 190 to 180. My favorite way of playing AMD, big red days, good volatility, selling puts way down here, which would pretty much, if we get a sign somehow, would completely erase this gap fill territory from the OpenAI deal and would give us a phenomenal first entry position for AMD, at least if we're trading the wheel, right? That being said, if we're looking for just DCAing long-term shares or stuff like that, I'm a big fan. Under 200 down to that 172 level, I'm a big fan of this pocket because we're just going for monthly consolidation, quite simply, right? Nobody is questioning the AMD long-term thesis, right? That being said, valuation is very fair right here, and the explosive growth is coming, but it's coming second half of 2026, and everybody needs to understand that, right? AMD is a multi-year story. It is not a next month story or a next quarter story. No. It's the next few years. So if you're accumulating AMD down here, you got to be willing to hold through for that thesis expansion. So please keep that in mind. Moving on to good old Amazon. Amazon up 2% over the course of the day today. Daily downtrend on Amazon as well. They got to get this one back too. So we need to break above 217 to reclaim a possible daily uptrend. Until that time comes, well, you're just in some sort of an awkward consolidation phase for the stock, right? Trapped in resistance right now, 216, then about 205. My favorite way of playing Amazon, very simple again. Red days opens up some great volatility to sell some put options below 200, 195, as I pointed out in yesterday's video. So please keep that in mind. Amazon's still one of my favorite buys in the market for the next few years. That being said, the valuation down here, about a 1.35 peg, 27 for price to earnings, and all lines of business firing on all cylinders. Amazon just in its own monthly consolidation phase. And you can tell in the context of bull markets, right? If we're buying between the 12 and 26, it's never really been a bad opportunity to be buying Amazon in the context of bull markets. You know, this is the great big bear market of 2022. So keep that in mind. Amazon's still a very big fan. On to Google right now. Google, more of the same as well, right? Unable to change the trend, still in the context of a daily downtrend, right? We need a break of 311.09. Give me the daily uptrend. Then we can say, okay, weekly lows are in, and then you need to work on the weekly trend change, similar to Bitcoin or stuff like that. As long as it's still weekly consolidation and a weekly downtrend, and the bears are in control, move lower. I'm looking for this one, guys. Very simple, right? 290 down about 275. If you give me this pocket and retouch this 12 EMA, maybe I can position a bit more for the short term or some other different swing trades. It's just, there's no alpha for me on Google right now at about 304, right? At 300, the valuation is not terrible. It's like a 26 forward multiple at a 1.75 peg. Definitely not the best bet in the market. I'm holding all my long-term shares. I'm not really adding any long-term shares. For me, that may come as a slight nibble if we retest this 12 EMA, but I'm not putting on any leaps from here. I'm not putting on any short-term swing trades either. I just don't think that it's the best buy in the market right now. It's a super high-quality company, and I'm keeping all of my long-term shares. But for me, it's just not the best buy in the market right now. Super solid. They're operating at full efficiency right now. It's ran a lot, right? It's ran a lot. You remember, I was just slamming the table on Google most of last year, and all those buys have been rewarded. So now I'm on to other things that haven't had that upside just yet. Another one of those is something like a Meta, right? Meta came down a lot last Friday because of their the news that they were delaying their large language model, right? So that being said, pretty sure nobody was waiting and massively looking forward to it anyways. But that being said, they were up 2.25% today. Now we are under resistance, 640 down about 630. The bulls held this for a while, and still in the context of this daily downtrend. So in the event that Meta has a few more red days this week, favorite way of playing this one is selling put options down here into the mid 500s around, right? I brought up METU yesterday as part of the 2 times averaged ETF, saying I was bidding around the 23s location. Not a recommendation. I'm just saying that I'm taking advantage of Meta's decline to play those 2 times average ETFs. You guys can do what you want. Obviously, the price action has been very choppy. We've been in a weekly downtrend and still in monthly consolidation mode on Meta. However, buying Meta between the 12 and 26, has it always been a good opportunity? You know, other than when Mark Zuckerberg just pivoted the entire company to the metaverse, right? Has it usually been a great opportunity to pick up some Meta? Absolutely. They're trading right now at 620. It's a 21 forward PE at a 1.1 peg. You'd be hard pressed to find Meta at these valuations at any point in time over the last like 3 years, right? So I am buying more Meta for the long-term portfolios, selling some options down here, and leaps are also a consideration. Moving on to Microsoft right now, similar to Meta, right? Microsoft just wildly out of favor. They had the uptrend. We're trying to set some higher lows. Anything above 390, trying to go for the daily uptrend continuation, but just super soft, right? Super soft. That being said, we bounced nicely from the 200 weekly moving average. Same concept. Whenever Microsoft hits this 200, guys, it's usually a buy, and this time is no different. Their business model is definitely not broken. They are down significantly from the all-time highs, still off 28% from those highs around 410 or slightly less, under a 25 forward multiple, a 1.34 peg, phenomenal opportunity both for leap call contracts or for adding shares to the long-term portfolio. And or on red days with good volatility, I'm selling puts well under the current market prices because I don't mind at all. And we're just coming out of weekly oversold conditions. So all things point to the fact that it's a very good location plus support. Very good location to be bidding some Microsoft right now, if you are a long-term investor especially, and various ways to swing trade it as well. Moving on to Netflix. So Netflix still in a bit of consolidation mode. They had that big Warner Brothers deal being canceled, pop, and as a result now they've just been consolidating out of daily oversold conditions. If you move down a little bit further, possibly going to retest some of these EMAs around the lower 90 range, but very decent balance, right? The bulls are now in short-term control. They've gained some tremendous distancy. This is a beautiful weekly bounce. If you're referencing like my Bitcoin analogies or anything else, if we're looking for longer term time frame trend changes like the weeklies, okay, you want to see a powerful 618 bounce like this, almost 70%, right? It just means that on the downswing after, the bulls have so much space to go for the higher lows and change the weekly uptrend. And when we can change the weekly uptrend, we can say, you know what? This is probably your monthly cycle low, and you may just be looking to reestablish either in one V shape, which would be surprising because they gave it all back, right? But at least in a two-phase attempt at reclaiming the monthly uptrend and following the fundamentals, because we know the fundamentals right now are pretty good. 28 forward price to earnings at a 1.43 peg. I am a buyer of Netflix under 100, right? Preferably as closer to 90 or under 90 as possible, but the whole time that it stays under 100 with my DCAs that come into my big portfolio every 2 weeks or every month, as long as Netflix is down here, I am a big fan, but eventually over 100, I will indeed stop buying. I've been loading up a lot over the past 3 months as Netflix has provided a phenomenal opportunity and the business model has not changed. Moving on to NVIDIA right now. NVIDIA. With that guidance through 2027, like that's insane, right? Absolutely insane guidance, raising from $500 billion to $1 trillion. Absolutely monster guidance from this company overall. Now that does encompass now through 2027. So it's very, very, very solid guidance, right? But let's just say we omit that guidance, which we shouldn't, right? I'll redo evaluation for you guys tomorrow, right? Because the street is going to start to price that in overall. Jensen wasn't exactly clear on how much of that would be attributed to the rest of 2026 and how much of that would be attributed to 2027. It's the combination. The way that people interpreted this was through 2027, not that 2027 revenue themselves were going to be $1 trillion. It's just the culmination of revenues through there, about $1 trillion. So, you know, if we're looking at forecast in terms of 2026 forward price to earnings, well, therein lies the challenge, right? How much weight do you attribute to the 2026 gains and then 2027? But one thing's for sure, right? It was already cheap to begin with, and now it's arguably twice as cheap, right? Because they'll be doing twice the amount of guidance. So that being said, as it currently stands, without tampering with the numbers just yet, I'm going to wait to see how the street prices this in tomorrow, okay? It's currently trading at a very low valuations, low 20s and a 0.92 peg. It's super cheap. With this increase in guidance, it's even a lot more cheaper than this, right? In my opinion, guys, NVIDIA is just one of the most no-brainer buys in the entire market. It all starts with NVIDIA. All roads lead to NVIDIA, right? And they are the end game at the end of the day, right? That being said, we are currently still locked in this area of support and resistance, very choppy price action. The big magnet, which is 185 down to about 180. If you break down lower, my favorite way of playing NVIDIA, just adding to my shares position. I will be adding more leaps, especially after today's guidance. And on any drops, I'm playing the wheel strategy, trying to get some short puts down here, farm some premium in the lower 160s. Solid company, excessively solid guidance. And we'll talk more about the token generation and whatnot throughout the rest of the videos over the course of this week, because I think it's very important. Wall Street is missing something very big, and a lot of retail is missing something very big in terms of how these AI factories and these token generation factories play into future SaaS models, how it generates revenue for big tech as well, right? You're undergoing a very big shift, and there is some alpha here. Wall Street has not priced it in. To be quite frank with you guys, I don't think they understand it. They do, but they don't at the same time. The numbers that they're giving to it definitely don't reflect it. So the market not fully appreciating the transformational shift that agentic AI is bringing to not only the software landscape, but also the big tech landscape as well. So keep that in mind. Moving on to Tesla right now. Tesla, a bit of a flat day, right? Nothing to report on Tesla. No daily uptrends just yet, so no price action shifts. You need a clean break above 415. It's just not happening. The market's just very, very choppy. So if we're swing trading long on Tesla right now, just please keep a stop loss below here, 380. I mean, not financial advice. You can do what you want, right? But if you close below there, you unwind the entire support range. The weekly is already in a weekly downtrend right now. And the last thing that you want is just to be unwound by an extra leg of monthly sell-offs down here to the 26 EMA, down to 360 to about 340, which would be arguably a better launch pad location, right? We know the valuation of Tesla right now is very expensive. People that are buying here are buying for the next 5+ years, because if you're just buying for the car business, obviously the valuation doesn't make sense. You're buying for the eventual, robo-taxi business, the energy business, services business, and the Optimus business as well. So keep that in mind. But the price action is holding, but just not displaying the most amount of strength at these lows, right? Moving on to Palantir right now. Palantir 1.17%. Also, just kind of like a bit of a bull flag right here. Super nice push off the lows. And then just a bull flag. I mean, it's a categorical bull flag, right? There's no other way to put it. Culmination lower is about, let's call it 150 down to about 140. This whole little support box right there. So Palantir is not looking too bad for the possibility of some further upside swing trade longs. Definitely a favorable company throughout this entire conflict, because obviously their military services are being heavily utilized right now. On the weekly timeframes, we also had a very nice bounce, right? It has been a weekly downtrend on Palantir for a substantial amount of time right now, but the bulls are trying to do a few things. Number one, they're trying to maintain this daily uptrend as long as possible and reclaim as much as this weekly timeframe as possible as well, to then reset the weekly, put an end to the monthly consolidation. But Palantir down here, right? The more, well, not a greedy way of playing it, but those of you that have an aggressive risk profile, you guys might be willing to sell some puts down here in the 130s. You might remember that I did it as well on the channel down here in the lower 130s. Not too bad. We're also adding some shares if you guys are big fans of Palantir. Valuation of Palantir right now, I mean, we did it at 135. Just add 10% to this. It's now trading at about a 115 price to earnings, but that would be about a 2.2, 2.3 peg. So the valuation has come down a lot as they printed ridiculous earnings the past 2 quarters, which has led to the multiples kind of compressing a little bit. And also the fact that they've come down significantly in price as well, right? But not too bad of a higher low temp by the bulls right here around the monthly 12 EMA. Significant bounce from those lows. You're looking for the bulls to convert this into the weekly time frame, reset the weekly uptrend as well. So that being said, Palantir, not the worst opportunity in the market right now. Moving on to SOFI. SOFI though, SOFI just not getting any love whatsoever. But at the end of the day, are any financials? No, right? They've just been riding this 12 EMA to the downside. Lack of, every time they get a nice engulfing move, they just fade and fade and fade. So I think at this point, maybe retesting some of these support lows is somewhat inevitable. 17 at about $14 is that support low. Key area of structure, an area in which we hesitated for a big portion of the early 2025 period, and obviously big support from back there. It's a big level, guys. 200 weekly EMA has just formed and is in that area too. And now the big monthly moving averages are here as well. Huge retracement off the top right now. I mean, it definitely looks like it. I was about to say it doesn't look like it, but it is 50% off from the highs right now. If you're a long-term believer in SOFI, I mean, short-term swing trades right here, very difficult, but long-term investor in SOFI, you got a lot to look forward to, right? But I think, let's be honest with ourselves, guys. For SOFI to eclipse these all-time highs this year, let's be honest, right? It may just be out of the question, okay? Will they be able to rally and recover? Yes. But hitting new all-time highs and having this amount of velocity, forgive me for my pessimism. I still own SOFI shares in the long term, right? So don't be too negative towards me. But quick, rapid momentum like that, I'm not too sure, right? At the end of the day, they are trading more and more like a bank right now. Their earnings growth is very solid. The revenue growth is very solid. The valuation is quite compelling. But at the end of the day, right, interest rates are hindering them right now, right? Less and less chances of interest rate cuts. You got to turn around those interest rate probabilities. You turn around the interest rate probabilities, right? You turn around the inflation probabilities, and SOFI is probably going to have a much better time. But there's a lot of narratives working against it right now. So I'm a fan of selling some put options down here, farming some premium while it's down low. They will be buying additional SOFI shares if we come down there overall. Moving on to Uber, last Uber and TSM. Uber with a nice 1.81 pop during the regular hours and then another almost 3% in the after hours. So Uber's trying its best to kind of reclaim the timeframes, right? Choppy, confusing price action. You guys can thank the war headlines for that, right? But the bulls are looking to establish a new up. For that, you would need really a nice break of 78.36. and start to take back more of this weekly, because so far it's been very soft, right? You can make an argument that we're going for the two-step weekly recovery process. I mean, we never really got weekly oversold conditions, but daily was all the way back there. Not daily oversold just yet either. So kind of like in between a couple timeframes right here. The clearest time frame of them all on Uber still, in my opinion, is the monthly time frame. We've come down back here to a very congested area of price action below the 26 EMA on the monthly. The valuation of Uber at 75, I keep saying it, right? Low 70s is super compelling on Uber. So I will be adding more, and I keep adding more. The whole time it's been in the 70s, right? I've said it. Mid 70s down to the mid 60s is my little pocket to continuously DCA for longer term shares, because I'm looking to carry this company for the next few years. And I do believe that the autonomous vehicle narrative against them is largely overblown. I think there will be a synergy relationship between autonomous vehicles and Uber. Uber has the large network effects that these autonomous vehicles need to onboard more customers, right? So there will be a synergetic relationship between a lot of autonomous vehicle players and Uber, at least for the foreseeable future, right? So they will be working together before they start competing against each other. Moving on to TSM right now. TSM, last but not least, up about 0.57% today. I mean, the price action just not the most solid, right? So line in the sand remains at 332. If you break to the downside, well, then weekly as well. You're going to break this 12 EMA, something we haven't really done. Broken and closed below. We haven't done that in a very long time. So pay attention to it. If that does happen and you unwind more of this weekly move, you're going into the inevitable monthly consolidation. And I could not be happier if that happens on TSM, guys. I've been waiting patiently for a back test of the 12 EMA. If that comes down here, lower 300s on TSM, and they give me a gift with all this visibility, all of this pricing power, and all this growth, and you give me a 310 entry again, putting it closer to a 20 multiple, putting it closer to a 1 peg, that is when I will be confidently adding to TSM again, because I haven't really touched it much on this rally to the upside, because it hasn't been one of my best buys in the market, right? It's a phenomenal company. I have a lot of it, and I've held it for a number of years, but it hasn't been my absolute favorite buy in the market. If you come down there, that will change, and I will start adding a little bit more to my position, waiting for the good old 12 EMA backtest, or in other words, at the end of the day, you're just looking for a new monthly higher low in the context of all this revenue growth and incessant demand for the company over the next few years. That is everything I had for you guys for the overall market rundown. Hopefully you enjoyed. Hopefully it gives you a better, better ideas in terms of how to navigate this market landscape, because I know there's a lot of narratives. People are doom posting all over the place, right? Some people are very, very, very black. Some people are very, very, very white, right? In terms of just super, super bullish or super, super bearish. But I truly believe that at all points in time in the market, right, you really got to be in between. You got to see things for how they are and derive from there, okay, high volatility, positioning, technical analysis, fundamental analysis, with all that together, what is the best tool as a trader, especially, or an investor? Like, what are the best tools that we can utilize to take advantage of this current market situation, right? So don't ever swing too hard one way or the other, guys. Don't ever think in absolutes, right? If you think in absolutes, it's already a very big problem, right? So always be open to the other side. As you can see, I'm always stating the bearish narratives and the bullish long-term macro narratives as well, right? Always the bearish short-term thesis, the bullish long-term thesis. We have to understand what resolves the conflicts. What are the things the market is looking to price in, to price out eventually, right? How it plays into the technicals, how it plays into the overall macro landscape, how it plays into the fundamentals, and then taking the best possible trade ideas and long-term investing ideas from there in relation to the themes that you know will be very popular for the next foreseeable future, right? Especially names in the AI theme. So that being said, did a lot of work on that. Now let's spend 10 minutes, and I promise 10 minutes, on the biggest gainers and losers of the day. Okay, so we'll start with a brief little stint in terms of our names to the downside. And the names that I want to focus on today are the cybersecurity names, right? I truly do believe that cybersecurity, of all software names, because we know IGV has been an absolute disaster recently, they've had a nice little upswing right here, and they can stand the test of time by backtesting the support zone and try to go for the trend change, right? But you guys know I'm not playing CRM, I'm not playing Adobe, I'm not playing ServiceNow. There's nothing wrong with those companies, but if I'm looking with the best of the best in terms of software, outside of maybe Microsoft and Palantir, right? I'm looking at the cybersecurity names. CrowdStrike with a nice backtest down here, lower 400s to about 370. Pay attention to it, right? Cybersecurity, if anything, of all software names, because we know recently there's now a lack of visibility. There's a lack of clarity for earnings predictability for earnings as well, and consistency. These companies all say that they're going to use AI and whatnot, but there's seat risk to a lot of these enterprise resource software players, right? So I'm not playing those. I'm not interested. The names that I'm highly interested in, which obviously you guys have seen the cyber attacks that Iran has done on companies like Stryker, on companies like even ISRG, right? Some of the medical devices names, those names have since recovered. But cybersecurity in the modern day and age with all the AI and with all this integration into clouds and whatnot, cybersecurity is going to be the industry of all these software names that have come down, in my opinion, that are the easiest buys amongst a relatively tough software backdrop. These are the names that have sold off a lot, and I truly do believe they have very nice upside. Now, we can either choose to play, some of my favorite players right now, CrowdStrike, Rubrik, which has some fantastic growth, but the share price just has not been helped at all by this software narrative, right? They had their earnings. We didn't cover them on the channel, but their earnings were fantastic. Phenomenal growth for Rubrik. Palo Alto Networks, also one of my favorite players. But if you want to avoid picking individual names, some of these cybersecurity ETFs, there's a number of them. There's CIBR, there's Bug, right? It all depends on what allocation you want, right? CIBR has some names inside of it which people don't agree with, such as Infosys is in there. Some people don't agree with that pick. And also CIBR also has like 7% in Broadcom, which, okay, they do a little bit with VMware and whatnot, right? But let's be honest, they're not a pure play cybersecurity player. The one that I have is WCBR because it's more of a pure play in cybersecurity. These are a multi-year plays for me. So instead of me taking a multi-year position in Adobe or Salesforce or ServiceNow or Team or a whole host of other companies that are just down tremendously from their highs that don't have very good predictability, let's be honest, right? I'm not saying that they're not going to go up. What I'm saying is that they do not have, these companies, they do not have the same amount of predictability as they had 2 or 3 years ago. It's just not the case, right? With the AI agents and whatnot, they're implementing their own AI agents and their client retention rates are still very high, right? But how far can you project that consistency into the future? What about the next 5 years? Let alone the next 6, 12 months. These companies can come from their oversold conditions and bounce back higher, right? However, will you ever get this consistency ever again? Or will it constantly be a push and pull battle of the narratives, right? The one sector of software that, in my opinion, will just not have a push and pull battle between the narratives because the TAM will just continuously expand and there'll be more and more demand for their services no matter what happens is cybersecurity. So that is the only portion of software that I'm interested in as a whole. So there you go. We just did 2 birds with 1 stone. We talked about software, but then we also talked about cybersecurity independently. Obviously, there's many more plays in here, but I am playing them under the context of a broad market ETF. If you guys want to play individual names, it's completely up to you, right? So that is pretty much most of the names that were read to the downside today. No need for me to talk about every single one of these. Those are the 2. That's the one niche and narrative that I'm pretty sure most people are focused on, right? Now let's talk about the names that have printed some nice green candles today. So NBIS up 15% on that renewed deal with Meta, which leads us to, because I haven't did the valuation for you guys, I didn't cover their earnings when I was traveling. I do apologize for that, right? But we had projected that NBIS down here, 80 to 90, especially back here, all the way back there from last earnings, was deeply undervalued in terms of forward enterprise value. Now, just to save some time, okay, I ran it through Grok right here, just in terms of enterprise value with the Microsoft deal, with the new Meta partnership deal, and also all the other businesses such as AV Ride, Triple 10, Toloka, and ClickHouse that NBIS has, which is why it's one of my favorite neo cloud bets in the market. It's also my heaviest neo cloud position. I've been very vocal about this. I own some CoreWeave, I own some IRN, but my biggest position by far is NBIS because of these other businesses as well. It gives them more enterprise value overall, right? So with the Microsoft partnership, which will bring them about 3.5 to 3.9 billion in annual revenue once fully operational, we know right now that these neo cloud providers are in the execution phase. Last year was the big part of the funding phase. Now we're building all the data centers, which is why a lot of the price action has been kind of weird. And then we're going to get the actual, well, they're actually going to be built and starting to generate some real revenue, right? Now, NBIS got another funding phase deal right now, but let's be honest, they're still in the execution phase as well as with these other companies. So if we take consideration that Microsoft partnership, when it's fully operational, Meta partnership, the prior 3 billion, and now today's new 5-year agreement valued up to 27 billion, 12 billion in capacity early 2027 with Vera Rubin, and 15 billion in compute thereafter. That adds about 5.4 billion annually at full run rate. Peak right? These contracts alone represent 47 to 49 billion revenue backlog for 5 to 6 years, 9 to 10 billion per year at peak. Plus the sum of the parts of the other businesses, AV Ride, 6 to 10 billion, Triple 10, 775 to 150 million. That's not too big. Toloka, 400 to 450 million because Nebius is a 51% stake. These are all different stakes, right? Now, ClickHouse as well, 28% stake, 4.5 billion in enterprise value. Total non-core positions, 11 to 15. So some of the parts, core AI at 60 to 75 billion, full run rate, plus non-core 11 to 15 billion, current run rate, gives you a 71 to 90 billion dollar logical enterprise value. Now, I asked it to include a margin of safety for execution risks, supply chain delays on chips, energy costs, et cetera. Puts the entire enterprise value 75 to 90 billion dollar range, which implies 130 to 170% upside from the current levels of the stock. If the AI demand sustains as forecasted by Gartner at 35% compound annual growth rate for cloud infrastructure, this valuation could prove conservative. Conversely, if hyperscaler spending slows, or this didn't include it, they dilute a little bit, it might be slower, and it could cap at 50, 60 billion. However, in both scenarios, there is still significant upside for NBIS. Bull case, a lot of upside. Base case, good upside. Bear case, still a 2x from current enterprise value, okay, which is just market cap plus debt minus cash on the balance sheet, right? That's going to change over time, obviously, but it's a $32 billion market cap company right now, which is why I was kind of saying so heavily, whenever it comes down here, 90 to 70, I'm a buyer of NBIS because this execution phase, I want to take advantage of it, right? Now we've popped, so I'm pretty sure everybody's going to be asking, is it too late? Is it too late? Is it too late? Well, short term, let's be honest, you are not getting the best possible price. That would have been back here when we were buying it on the channel, right? However, at 130, can you still justify buying up here? The answer is yes. However, you have to have a very long timeline, right? The quick money from a quick swing trade has largely already been made. It doesn't mean it can't go up. And if you buy here for a quick little swing trade, you can't make some money. I'm just saying risk to reward wise, the best shorter term swing trades were obviously down in these lower levels, as we were kind of saying, right? However, if we are buying from the long term, does it still make sense to buy up here, or are we well beyond reasonable valuation? Well, don't take it from me. I put it through Grok, right? Just to break down some of the parts for everything with all the recent deals and the rest of their enterprise value from their other businesses. It just goes to show there is some decent upside in this business still, but you have to have a longer term time horizon to justify buying at 130. I don't want anybody to buy at 130 and then be disappointed that it pulls back to 115 or 110, right? Because we're buying it for the next 2-3 years, but we want all the gains right away. That's not how the game is played, unfortunately, right? So I'm personally not buying any more NBIS up here because I'm full. I spent the last 6 months buying NBIS down here. So I'm full. But if I didn't have a position, and this was the first time I'd ever heard about the company, or I had been waiting for it for a while and I feel left out, well, I'd be nibbling here and probably buying through a backtest of support down here, $100 with a multi-year thesis. So hopefully that makes sense, right? Taking in consideration other names, obviously BMR is off the lows. If you guys want to play Ethereum proxies, it's up to you. Circle, super solid. We haven't talked about Circle enough, but you might remember, we talked about it last week, right? Circle is a position that I started at 140 and I nibbled around 100, I nibbled around 80, but I did not buy these 60 lows at all, right? So my average cost is right around $100 right now. So I'm currently in profit, but this is a multi-year play just on the expansion of the network. And that's always been the case for Circle, right? Yes, it will move with the general flows of crypto, right? However, it'll also move if they just expand the network. And that's always been the thesis. And right now they're expanding the network at a very rapid pace, as you were able to see on last earnings. So Circle, is it still a buy from here? Yes, but for a multi-year thesis of these stablecoin networks being utilized more and more and more from the back ends of the banks for processing transactions and all of that good stuff, right? So pay attention to that. Are we late on Circle? No, but similar to NBIS, right? Don't expect as rapid gains from the lows to here as you would get from here, expecting another 2x in record amounts of time, right? If we're buying here, we're buying with a multi-year thesis. If not, it just doesn't make sense. But the momentum is looking very strong, obviously, right? So IRN, same thesis, right? The thesis is just They need more compute power. Jensen was very clear about that today. IREN, CIFR, Wolf, whatever your guys' favorite play is, you guys know what my favorite plays are, right? It's not that these other ones aren't good. It's just that I'm loaded up on the other ones. CIFR is very interesting, especially down here, right? Lower 15, $14 range. They're clearly establishing a longer form attempt at a bull flag right here with a slight almost back test of the 12 EMA, but you can clearly tell, right? Just monthly consolidation range right now. So buying at the lower end of here. A lot of good deals from Google and Amazon. It's the only thing that I roll on the chart just to, you guys can put it through AI as well. If you want to know forward enterprise value, it's up to you. Moving on a little bit further, I guess we can talk a little bit about the memory names. SanDisk and Micron had an explosive day of action today. SanDisk popping above the highs right there, and Micron as well, popping above the highs. So very nice new daily uptrend established right now. It's been in bull flag mode, and we've commented about this so many times, waiting for the back test, short-term momentum of the 12 EMAs. I had a little bit of swing trade position on Micron, and a SanDisk was also a very good bet. We talked about this, back test of the 12, just wait for it. It's offered this trade to you many times throughout the current progression of Micron and SanDisk. Obviously, these companies are undervalued. If you do not believe this to be, well, let's just say if you believe that the memory shortage is going to last for more than just a couple months, if you take these companies' word for it and it lasts through deep 2027 overall, as so long as NVIDIA doesn't find a way to circumvent the need for more RAM. There was some hints at that, by the way, in today's GTC conference. I got to look deeper into it as to how it would affect them, right? But overall, right now, there's two types of people for these trades right now. Some would deem these companies to believe they would believe them to be very cyclical, as they have been in the past, where if they have low price to earnings multiples, it means that they're at the peak of their earnings power. Because these are how these works, right? They peak in terms of earnings power, they get super low multiples, and when they're at the lows of a cycle, when you should be buying them, they'll have very high PEs. Why? Well, because their earnings come down, because the demand comes down, right? So that, like, it's odd. You see that they have very low multiples right now, but there's a whole cohort of the market saying, well, that's usually when you should be selling some of these memory names. And that so far has been true for the last like 15 years in these names, right? This time is a little bit different. So I do still believe that these names can still have very decent upside from here because the demand, they're just going through a demand cycle that they haven't had before, right? In the past like 15, 20 years. Let's be completely honest, right? So there is further upside. The stop losses should be maintained as we were talking about, right? Off these bounces from the lows. As soon as we started bouncing, easy lows to be set. 12 EMA, they've respected it so far. This is true on this, on SanDisk and EWY as well. EWY with a fantastic backtest of their own 12 EMA. This is just a proxy for trading Samsung and SK Hynix because they do represent like 46% of that index. So EWY, I'm not in this one directly, but I'm probably going to be positioning soon. So keep that in mind. Other than that, it's just more of the same, right? CoreWeave, et cetera. We talked about Reddit. Reddit's a great deal, but arguably at these metrics, right, you got a couple fantastic software opportunities. Well, software, social media, software, that whole landscape, right? Whether it's Reddit. One of my personal favorites, I've been very vocal on this one, has been AppLovin back down here. Very solid. Meta, obviously, right? But Reddit is a very close follow-up play as well down here in the 130s. The valuation is very compelling right now at a 0.81 peg. Price to sales, not so much, but they have very strong growth and very good margins, right? So I do believe on Reddit's ability to recover from here. I'm just kind of picking and choosing which ones I want to talk about through this entire list. I know we covered a lot of them last week as well, but just to reiterate some. By the way, hopefully you guys enjoyed last Thursday's video. Last Thursday's video, at the end of the video, I talked a lot about the stocks for long-term portfolios, right? So today we'll cover the biggest gainers and losers, just like in, in descending order and whatnot. Talking maybe a little bit more about some plays that I'm looking at closely. Rocket Lab, very interesting price action here. Very nice support lows, right? Swing trades, easy stops below lows, and then you're targeting weekly re-expansion of this trade and possibly monthly re-expansion of this trade. It's off the 12, which is why we should be trading with the stop loss, but short-term swing on this one, very interesting. A lot of the space trades, very interesting. Fly, right? Some other ones that are down as well. Very interesting. ASTS arguably is something similar where they're trying to get the higher lows in motion and go for it with a nice clean stop loss area below there. And you're just looking for re-expansion of this chart. So interesting plays across space. It brings me into the chart of KTOS as well. Breakout and they're retesting the range down here, not quite back to the 12, which is why then we got to be diligent with our stop losses going for short-term swing trades, right? But you can clearly see they're trying to establish some pattern lows, right? So just some swing trades to pay attention to. Other than that, tomorrow we'll have a bit more time. I'll dedicate more time to this. And tomorrow we'll talk more about the themes, the energy names, the small cap names that I've been talking about for a long time right now, right? So Thursday, we covered long-term portfolio buys. Today, we're just going straight through biggest gainers and losers with an emphasis on NBIS, the neo clouds, the memory names, you know, and then we spent some time on cybersecurity to the downside, right? And then tomorrow, we might just go through, you know, the themes, right? Military again, energy again, drones and defense, or second order plays of AI, like what's happening with the photonics names, etc. I can't do everything every day, so I'll kind of just rotate between them, right, type of thing. So that's everything for me today, guys. Hopefully you guys enjoyed. If you did, consider dropping a like. Would appreciate it. Consider subscribing to the channel as well. If you're new, would love to have you back. And if you have any questions, comments, feedback, or if you guys are contemplating any plays of your own, leave them down below in the comment section. I always love hearing from you guys overall. And that's going to be it for me today. Hope you guys a good day in the market. As I said, don't get ahead of yourselves. You can see the futures right now. It's just so choppy, right? And expect further chop as long as this conflict is not resolved. And we keep getting back and forth narratives, right? So that's it for me. Enjoy the rest of your evening, guys. I will see you tomorrow after the market close. We'll cover more charts, you know, especially at the end of the video. But Mondays are usually like, we got to recap so much stuff from the weekend and, you know, go through a lot of the sectors that we don't cover on a daily basis. So tomorrow I'll try to do it faster and get to the end of the video a little bit faster too. That's it for me though. Enjoy the rest of your evening. Have a good one tomorrow in the markets, and I'll see you guys after the close. Peace.